or you get two of me.
Yeah. Morning, everyone. I'll just give you a couple of minutes for everyone to join. There should be a poll on screen shortly. If you could just answer that for us while you're waiting, please.
Two of you again, Andy.
I know, it's weird.
Can't get enough.
Like I say, having me in stereo can't be a bad thing, though.
Arguable.
They're cloning us now, Jordan, and sending us all over the country. It's a new thing we've got going behind the scenes, cloning the regional sales manager.
Yeah. Around for just another minute, just give people plenty of time to join. As I say, there should be a poll on screen when you enter, so if you can just answer that for us. Perfect. It looks like we might all be about here. So hello, everyone. I'm back again, which means it's time for September's Lender Spotlight. Thank you all for joining. My name's Jordan and I'm the account manager at Knowledge Bank. And today I've got the pleasure of being joined by Paul Friars, Managing Director, and Andy Rowe, Regional Sales Manager at Zephyr Home Loans. Zephyr Home Loans are like-to-like lender, providing products that meet the needs of professional portfolio landlords and other specialist property investors. Shortly, Paul's going to give us a market overview. And then I believe he's going to stick around for the Q&A session as well, where I'll be asking all your questions. If you do have any questions throughout the session, then please do use the Q&A box at the bottom of the screen. We'll get through as many as we can today, but if we can't answer them all, then we'll pass them over to Zephyr so they can get back to you directly. This should have been, like I say, a poll on screen when you entered the session. So thank you all for answering that. There'll be another one around halfway through and then another one towards the end as well. So if you could answer those, it'd be much appreciated. We should be here for around 45 minutes to an hour, just depending on questions. And you'll receive your confirmation of attendance, which can be used for CPD from Knowledge Bank over the next couple of days. So good afternoon, both of you. Thanks for joining us. And yeah, Paul, over to you.
Yeah, thanks, Jordan, and thanks again for arranging this. I think this is about the third or fourth session that we've done with Knowledge Bank, so I really enjoy these. And what we've generally done before is just given a bit of a view as how we see things across our broader business into the market, just with a few stats and such like. So I'll just take a few minutes on that before Andy then, as you say, picks up the technical side of it. I mean, I guess what we're seeing in our business is that there is, and I'll refer to the DPS, Deposit Protection Service, on a few times, which is the tenant deposit pool that we look after on behalf of government. You know, we're certainly starting to see signs of normality, I think, come back into that, you know, with sort of growth through the year with new tenancies and such like. So, you know, which is quite a contrast to where we were 12 months ago, stating the obvious, you know, when we were coming out of lockdown and such like. So I think generally it certainly feels like things are positive. And we've also got, you know, just in terms of that inflow of deposits, we're expecting, you know, quite a significant inflow shortly as students go into, you know, back into university, which again, this time last, you know, 12 months ago, that was all quite difficult and different with COVID in mind. So, and I'll pick up on that at the end, just with something to point the attendees to around sort of student list. I think in terms of market, you know, what we're seeing is that from a funding point of view, which obviously is critical for lenders to be able to put product out there, for brokers to be able to advise clients on, we're seeing things has been pretty rosy at the moment. I think it's fair to say, you know, the We do securitise our mortgages, and the most recent securitisation was put out just around 6 weeks ago, which went through very, very well. Great demand from investors to buy into mortgage securitisations holding specialist buy-to-let mortgages. So that looks very positive. And across our broader servicing business, Zephyr being a part of a much larger sort of mortgage servicing business, we're seeing multiple securitization deals go to market at the moment. So things do look pretty strong in that regard. And I think that's also taken a step further on with, news of late of, specialist buy-to-let lenders being sold as well, so fully becoming part of other institutions. So we've got Fleet Foundation, TML, a little bit a few more months ago, been bought up, which again, just from a point of view of the health of the sector and such like, points to things being positive, I think. I think the other thing just to call out is that, in terms of the performance of buy-to-let mortgages, I think much has been spoken over many years about, stresses coming into the market, taxation changes, etc. Certainly our experience at the moment is that the buy-to-let books that we look after are performing very, very well. If anything, performance has increased through the past 12 months, which, considering where we were 12 months ago, may be a surprise. I think, we may need to not necessarily quite have the rose-tinted specs on too much, because, we're still in an economy that has been supported. I think, with furlough finishing this month, and we've still got SDLT tapering to fall away. So, we all pay close attention to, the back book performance, but at this point in time, things are pretty resilient. So I think the general view that buy-to-let is a resilient investment for people is pretty clear to be seen at the moment, I think. I think just as we do get back into, a more normal place than we have been, just looking out down the track, there's obviously the increasing sort of focus on the green agenda for all the right reasons. You've only got to look at the weather around the world. In New York lately, it was pretty, our chief financial officer is actually based in New York, and I know that, he said that the weather over there lately was absolutely insane. So certainly a number of lenders coming out of green products, and I think, at a country level, the government has committed to being carbon neutral by 2050. I mean, I think the housing stock, within the country has got a part to play in terms of, making property more greener. I think there's some interesting stuff to drop out of this that I think will become something that's more visible to the market. There is a consultation out there with from government at the moment on, making it mandatory for new tenancies to only be taken on properties with an EPC grading of C from 2025. That's not very far away at all. And I think, there's discussions in industry at the moment around, how do you deal with cost of retrofitting property, to get it up to a C from where many will be at the moment, which is likely to be an E, for property that's quite old. So I think some interesting stuff in that, and I think just staying abreast of those developments, could well create, opportunity as financing needs of the buy-to-let stock may start to change. So we'll wait to see how that all plays out. I think then just to round off before we get into the questions, which is what we're all here for today, just back into the student point. I mentioned DPS. I'll just try and share my screen, Jordan. Let's just see if this works. Just a pointer for the folks on the call today. The website page, just let me know when you can see that, Jordan. Hopefully it'll come through in a sec.
Yep, all good.
Yeah. So just from a point of view of tips and hints and such like for landlords and for tenants, this is the DPS, Deposit Protection Service, which is a sister company of Zephyr. We look after 1.4 million tenant deposits at any point in time. We have a learning centre on here, which anybody can get into. You don't need a login, it's all publicly available data or information. And there's just some stuff on here around just topically, preparing for a student tenancy, the type of things that, landlords should be thinking about if they're new to the sector, and just a few helpful sort of logical points really, which hopefully from a timely point of view, relevant. And there's a lot more on this as well, just from a sort of a general CPD point of view. There's other things on here around legislation and such like, which is all there and readily available. So that's pretty much what I was going to say, Jordan, really. So I think, you know, hopefully more normalcy coming back into things. I guess, you know, the vaccine is obviously playing a part in that, so we pay close attention to how all that's playing out. But you know, from a point of view of the buy-to-let market, you know, things seem to be in a pretty good place at the moment. And yeah, I think I'll call it a draw there, and then we'll get into answers to questions, I think.
Perfect. No worries at all. Thank you for that, Paul. So that website there is depositprotection.com as well, just for those that want to make a note of it. There we go. Thank you very much. So yeah, thanks for that, Paul. There've been a few questions flying in. So again, if you do have any questions at all, then you can use the Q&A box at the bottom screen. So that's any cases that you're currently dealing with, or just anything generally that you'd like to know about Zephyr or the market in general. Like I said, we'll get through as many as we can today, but if we don't manage to get to them all, then we'll pass them over to Zephyr so they can contact you directly after the session today. If we can put the second poll on screen as well, please, Paul. Thank you very much. Just give you all a second to answer that for me. And then there'll be, once you've answered that, there'll be another one at the session, at the end of the session as well. So yeah, moving on to the Q&A. So we had a few questions on the registration form, which you'll all have seen and hopefully asked. The first one was, what restrictions are you seeing with lenders when placing SPV business? So Andy, if you could give us an overview of your stance in these areas, just to see if Zephyr can assist. So Hira has been in touch, and he's saying that landlord experience being required for HMO applicants is being an issue. Is there anything that you can put forward on that?
Yeah, well, I mean, most lenders are the same in this space, Jordan. So we're looking for applicants to have some experience in the background, and certainly it's the same for Zephyr. I think where we're slightly different to a lot of lenders, though, is that we only require one applicant. So whether it's an SPV application or an individual application, and we'll accept up to 4 applicants, you could effectively with Zephyr have, as long as your first applicant met our experience rule, the other 3 could effectively be first-time landlord, first-time buyer. So there does create a degree of flexibility there. And we certainly see a lot of applications where, you know, dad's coming on board with son or daughter, or mum's coming on board with son and daughter to help them get on the property ladder, and mum and dad have got experience. So for us, if it's a standard property that the clients are looking to buy, we just need the one of the applicants to have 1 year's ownership of a property, and it doesn't have to be a buy-to-let. So John could be living in London renting. He might own a property in Wales that his mum and dad lives in, but he wants to do a buy-to-let in Hertfordshire. That would work with Zephyr. So we've got some flexibility there. If it's an HMO, specifically to the question, or a multi-unit freehold block, then we do expect the landlords to have 1 year's letting experience. And I think that's probably the same for most lenders. There is more technicality involved in running an HMO with potential licensing, the variation on having more than one applicant in there or one tenant. So you're thinking about whether you've got an individual AST or a multiple AST on the go. So there's lots of other considerations to think about. And I think as a first-time landlord, you could be biting off more than you're ready to chew. So, and lenders are aware of that. So they're just looking that landlords have had some experience of running a property.
Fantastic, thank you. So Julian's been in touch saying employment history and income has been a problem. So I mean, it's a slightly vague question, but is there any sort of information you can give on your expectations of history and the income tests that you need them to pass?
Yeah, so it's a good question, because the income rules around buy-to-let are complex, and they vary from lender to lender quite drastically. Certainly from Zephyr's point of view, we do expect to see that applicants have an income. Okay, certainly And we want all applicants to have an income unless they cohabit. So if you've got a husband and wife, and husband is earning and they've got shared bills and wife isn't, then we can look at that as an exception. But the standard policy rule for us is that we do expect to have an income. What's interesting, Jordan, is that we break income down into 4 sections with Zephyr. Okay, so we've got employed income. So somebody may work for Tesco's, for instance. We've got self-employed income unrelated to property, so an accountant or a dentist or electrician. Thirdly, we've got pension income. Now, if you've got an applicant that's got one of these 3 income types, then we have a no minimum income rule. And quite literally a no minimum income rule, which then leads on to the question, do you have a background affordability test, which I'll come back to in a sec. The 4th income type we have is landlord derived income. And just as a footnote here, if you've got people with multiple income streams, so someone who's an accountant, for instance, runs an accountancy practice, but also has a portfolio, you, at the application point, you only have to declare one form of income, okay? So with the landlord income, we are looking for landlords to have a minimum gross rental of 25k. So the reality of that is on their SA 100, they may show gross rental coming in at 25,500 for sake of argument. And their SA 302, which is the document showing their net profit figures, may be as low as 8,000 or 5,000. That's fine for us. But the point of demonstrating the gross rental income is to see that they have enough serviceability there in the background. And coming back to that serviceability point I mentioned earlier, question I frequently get asked in the field is, do you have a debt to income ratio in the background? And we don't at Zephyr. But what we do, of course, is a prudent underwrite. So when an underwriter is working through a case, if they see that someone has high indebtedness in the background, and that's irrespective of the size of their income, they could be earning 3,000 a year, they could be earning 300,000 a year. But if that income or that indebtedness in the background is high alongside the income, we don't decline the application. What we do is that we then ask to see bank statements, because what we want to be able to demonstrate is that the applicant is running their account or running their accounts properly. They're not going into overdraft regularly or going outside and agree overdraft. They're managing their affairs properly, and that's what we're looking at. It's about prudent lending at the end of the day.
Fantastic.
I think
Sorry,
I think the answer to that question just shows, doesn't it, what an area of detail that is.
Absolutely.
And I can well understand, why, sort of brokers on the call today will be sort of, having difficulty getting their head around, how things can vary from lender to lender. I mean, I would just encourage anybody in the call just to pick up the phone to Andy and his colleagues and talk through, what we can do, because I guess, that may be a slightly quicker way of doing things, or obviously talking to Knowledge Bank. So yeah, complex, isn't it?
Yeah, absolutely. And for any other brokers that are on today and have got smoke coming out at the end of the pens trying to scribble all this down, there will be a recording available on Zephyr's website over the next sort of coming few days. So yeah, thank you for that. Moving on to the next one, Emma and Mandy have asked a similar question, which I thought was quite interesting. It's saying that the number of directors in the company is different to the number of shareholders, and that's been an issue.
That's thank you, Emma and Mandy, for that one. That is an interesting question, and it's one I get asked a lot, actually, because a lot of lenders out there, Zephyr are really good in this area, by the way, guys, so I'm quite excited that this one's come up. Chance for us to really shine what we do. A lot of lenders want to see both directors and shareholders on the application. We're completely the opposite. We only want directors on the application. Now, directors can be shareholders or non-shareholders, but because they control the business, they must be on the application, and we'll allow up to a maximum of 4 applicants on an application. So to give you some ideas what that might look like, Jordan, let's say you've got a mum, dad, son, daughter type team, right? Mum and dad are the directors, son and daughter are the shareholders. We would expect mum and dad to be on the application. All right, they would sign the personal guarantees. Son and daughter, we don't look at them at all. We don't underwrite them. We don't look at them. So son could be 25, and like my son, for instance, he works abroad. So he could be working abroad. We're not going to underwrite him. So the UK based side of the application doesn't come into play. Daughter could be under the age of 21. My daughter she's 18. So for Zephyr, we have a minimum age of 21. So with my son and my daughter, they wouldn't fit policy because of age and their situation from a residency perspective. But from Zephyr's point of view, we wouldn't underwrite them anyway. So that really helps people with shareholders in the background. Couple of footnotes on that though. Firstly, directors must hold 60% of the business. That's a minimum requirement for us, okay? And secondly, shareholders cannot own more than 20% individually of the business, because if they do, they would then have to become a director and go on the application, or they'd have to reduce their shareholding if they didn't want to go on the application. But it does mean that there's a lot more scope in terms of not underwriting that background individual. And the other beauty of it is we often see situations where you've got a shareholder that's put money in the company, okay, but it's now company money, okay. The company wants to do the lend, so the company comes to Zephyr for a lend, and it must be an SPV. The director goes on the application, but they've not put that money into the account, but it's sitting in the account and it can be used, because that's often what I very regularly get calls on it saying, well, I've got a shareholder that's put money in. Do you require them on the application? No, we don't. So there's a lot of flexibility around that whole background piece with us in terms of shareholders and what we're looking for. And you can have as many shareholders as you like. So you might have a situation where you've got, I don't know, 2 directors that have got 60% of the firm and then 40 shareholders in the background. Doesn't make any difference to us because we don't underwrite them, we don't look at them, so it makes it really easy.
Fantastic. I think that's answered that one. Thanks for that. So we've got, excuse me, Carol has asked, she's got a foreign national as a company director. Does that make a difference at all?
Well, it depends where they're residing. So if they are residing abroad, then it's a no. If they're in the UK, we'd be looking for them to have indefinite rights to remain. So, you know, they would need that, and that would be the same whether it's a company director or an individual. Going back to what I was just saying, if they were a shareholder and they weren't going on the application, it wouldn't matter. But in the point of being a director, they have to go on the application, so they have to meet our residency requirements, which would be indefinite leave to remain.
Fantastic, no worries. Kishore has asked about maximum LTVs. He said that that's been an issue, not necessarily about Zephyr specifically, but could you give us an overview of what those are?
Yeah, again, it's a really good question, isn't it? Because, you know, historically, if I look at my background and some of the lenders that I've worked for, and historically when I was a broker, very often what you see is when things start to get technical, and a good example of this is minimum lease remaining. So for us at Zephyr, we want 70 years left on a lease at the end of the term. Okay, so if someone came to us and there's 80 years on the lease, but they wanted a 9-year term, that's fine. But what a lot of lenders will do when it starts getting near to the end of the lease, or if there's some other technicality, is they'll do the lend, but they'll reduce the LTV. Because what they're doing by reducing the LTV is giving more buffer should they ever get into a possession event, in terms of having to reinstate that in that scenario, reinstate the complete mental back, the lease. Thank you, Paul. Yeah, reinstate the lease. So, you know, I think with Zephyr, we underwrite a case completely on its merits, and our LTV bands go up to 75%. And if the case fits our policy, you can have 75%. It's as simple as that. We don't ever restrict LTV because of some background issue. It either fits policy or it doesn't. So we're very black and white in that respect.
Perfect. Michael has said the number of rooms has been an issue.
Yeah.
I don't know how many number that is, but
yeah, well, I think there was a changing of the rules back in, I can't remember exactly when it was now, 16, 17, from a valuer's perspective in terms of indemnity cover on valuing properties. And what we're seeing now is that, you know, there are a great many lenders in our space will lend up to manage a maximum of 6 rooms. Now, this is a bit of a quirky area because you've got different types of property types. So you've got C3, which is a dwelling house where you've got a family living in it that are on a single tenancy. You've got a C4, which is an HMO. Now, C4 could be a 2-bed HMO, it could be a 20-bed HMO. And there are lenders out there that will go to 8, 10, 15, 20 bedrooms. But they're in the minority. And certainly for us, we will lend up to a maximum of 6 on an HMO basis. Interestingly, if you've got a property that's a C3, so it's a dwelling house and it's not an HMO, but it's got 7 bedrooms, because it's a standard property on a single ST, we can consider that. But on a C3, on a C4, what will happen is we can only get a bricks and mortar valuation, which is what we require as part of our underwrite, on properties up to 6 bedrooms. And once you go over that, it's a different type of valuation. It's an investment backed valuation, which we can't accept, which is why we won't do a larger than 6 beds. So certainly for us as a lender, HMOs up to 6. If it's a standard property, we can consider more, but give us a call and we'll talk you through the finer detail.
Fantastic. So on that one again, we've got Amjad, who said that newly formed companies has been a problem. So again, I don't know how new that is, but what's the sort of timescale you'd expect the company to be around for before?
Yeah, I know. Yeah, some lenders will want the company to have been formed for a year. They'll want to see accounts in the background. Again, another great spotlight for Zephyr here, because you can set up an SPV today and we'll accept it. So brand new SPVs are fine. Another thing that we often see is SPVs that were previously trading companies. And again, a lot of lenders don't like that. We're fine, as provided that trading SIC code. So SIC code, for those that are on the call that are not sure what that is, it's a standard industry classification, okay? And every business in the UK gets issued a SIC code depending on what it does. And there are 3 specifically that we look for when we're doing an SPV application, Jordan, which are 68100, 68209 and 68320, and we can have one of those or all 3 of those, it doesn't matter. But provided one of those SIC codes is on the application, on the company, and there are no other SIC codes, so as long as a previous trading SIC code has been removed, we can accept that as well. So newly formed or recently changed into an SPV, that's fine for us. And it is a problem because a lot of landlords now are getting told to set up new SPVs, take properties out of individual names and put them into limited companies for the tax benefits. They're trying to get things moving and get things done, and they hit this hurdle where they've got to wait 6 months or 12 months before they can make their application. So another area where we're really strong.
And I think this is kind of getting into the heart of specialist buy-to-let, isn't it, really? Because you kind of got, a large number of lenders who are operating in the buy-to-let market, but actually there is a subset that you would deem to be specialist. Now, I think there is becoming more of a grey area between, prime buy-to-let lenders and specialist buy-to-let lenders. But I think this structural company point is really at the heart of where growth is in the buy-to-let market. And Andy's mentioned tax. We're not tax advisors, so I would always suggest that from a sort of a broker advice point of view, there's some form of linkage across to a good tax advisor. But I think this is really getting to the heart of the sort of stuff that we can do, being a specialist buy-to-let lender. And perhaps the questions come out of the fact that maybe other lenders were trying for this sort of stuff. I don't know.
Absolutely.
Yeah, it's a good point, Paul, because I mean the whole SPV arena is such a complex arena, and one of the we get regularly questions about company layering. We regularly get questions about how can I get money from one company into another company. If I take it out as income, I've got to pay tax on it, but I want to use it without paying tax. So I want to do company layering, or I want to do this, I want to do that. And it's becoming a very, very complicated market, and people need to, as Paul rightly said, I mean, we would always be looking that the client had taken a bespoke tax advice as part of the underwrite, that we've seen that what they're doing is in line with the tax advice that they've been given and in conjunction with their advisor. And then we can look at how we can structure that deal around what they're looking to achieve. So there's lots of opportunity there for people.
Absolutely, yeah. And I just think similarly to that, we've just had a question in actually from Nikesh, who's asked, he said that he's got a few cases where a residential owner wants to sell their current residential to their SPV limited company and then buy a new residential in their personal name. Is that acceptable?
It is, but there's some caveats. So one of the grey areas in the market, I think, and I don't think lenders help brokers here, is consumer buy-to-let. Okay, what is consumer buy-to-let? When does it apply, and when doesn't it apply? So the situation we have here is that effectively we have a let-to-buy transaction where the client is moving that property into a buy-to-let scenario, and they're going to go and buy another residential. We're absolutely fine with that, provided they own another buy-to-let currently. So we as a lender follow the Council of Mortgage Lenders decision tree, and I can send that to you actually, Jordan, if the guys need access to it, and you can send that out to everybody, because it's a really useful flow chart that explains what the Council of Mortgage Lenders deem to be consumer buy-to-let. Now, there are lenders out there that determine when a property moves legal ownership, i.e. from individual name into an SPV, because the legal entity that owns it is different, the consumer buy-to-let rules don't apply. We don't see it that way because the director, which is ultimately owner of the company, is the same individual. So we still see that the technicality is there from a consumer buy-to-let perspective. So to answer that question concisely, if there's no other buy-to-let in the background, we wouldn't be able to do it because we'd class it as consumer. But if there is, we would be able to do it.
And I think the consumer buy-to-let space is quite interesting, isn't it? In the sense that, you know, what I think happens is that lenders generally that securitize mortgages would generally not do consumer buy-to-let. There are some exceptions to the rule, but the general approach is that securitizing lenders don't offer consumer products, whereas retail-backed lenders, banks, building societies, will often provide a route forward for consumer. So I think that's kind of almost flipping around what I said before around the SPV stuff being very much specialist and the consumer piece being perhaps, you know, very generalized, more in that sort of high street space. Minor point of correction, CML guidelines now UK finance guidelines, if you want to look at those, with the trade body changing name a wee while ago. But
apologies.
No, that's fine.
Fantastic, yeah. I think just going back to the company layering element of it, we've had a question in from Ujwal, who's saying that there's a subsidiary SPV. So I mean, kind of covered that in what we said. I don't know if there's any more that you can go into on that. Really.
Well, there probably is, to be fair. I mean, there are lenders out there that will allow company layering. So whether the SPV is owned by a parent company or whether the SPV owns a company below and is the parent by default. And as I say, generally, when we see those kind of transactions, it's because there's money in that parent company that they want to get into the SPV to use as a deposit monies for a purchase. That's generally what we see. That's not wholly what we see, but 99 times out of 100, that's what it will be. We won't allow that. So we don't do any type of company layering. But the way that we get around it is that we will allow an intercompany loan. So provided the shareholding and directorships are equal across the two companies, company A, the parent company, if you like, can lend the SPV a sum of money as a deposit. That's absolutely fine. We'll just be looking for a board minute from the directors to show that they've convened a board meeting to allow the company to loan the money. And the only thing that we specify is there can be no repayment terms in place whilst our charge is on that property. So as soon as they redeem our charge in typically 5 years at the end of a fixed rate, for instance, they can then start a repayment structure on that loan. So it gets around it because they're not then having to pull it out as income or dividend and pay any kind of tax or NI on it. They're putting it across into the company. And when they pull it back out, of course, they can then charge loan repayment interest on that. So there is a benefit to doing it that way as well. So we can get around it, but we can't allow company layering.
Fantastic. So we've just got one more on the pre-asked questions, and there's a couple more coming in the Q&A just around SPVs as well. So Neil has said that a few lenders have been reluctant to accept very large portfolios, which, I mean, again, I don't know how large that number is, but if you could just give us a bit of an overview of what you like and what you don't.
Yeah, well, I suppose that question goes into two potential answers. One, the amount of portfolio that lender will accept in terms of what they're going to lend against, and secondly, background portfolio that is not coming to that lender but sits in the background with that client. And I know there are restrictions on both sides with many lenders. For us, we have no limit on the background, so the client could have 1,000 properties. As far as we're concerned, we don't care, frankly. What we're looking at is the stress test, and again, an area we're really strong. So many lenders are stressing at 125 or 135 at 5 or 5.5. So you're needing to have really strong rental coverage in the back. Historically, what we've seen as a lender is especially a lot of lenders, landlords in the southeast that have got properties that are not necessarily so high yielding, but they're obviously getting equity growth. Maybe they don't fit that difficult stress test. For Zephyr, our stress test is really simple. It's 100% rental cover. So provided that background rental income is equal to or greater than the mortgage payments on that background portfolio, and we accept the fact there might be voids in there because we'll look at a business plan, that meets our policy. So it's a really simple background stress. In terms of properties coming to Zephyr, what will we accept? We've got no limit on the amount of properties. Well, we probably would if you did a little bit quick maths calculation here based on our minimum loan, but we will lend up to 5 million, all right, to an individual. So let's say you've got a husband and wife team. Husband could borrow 5 million from Zephyr on his own. wife could borrow 5 million from Zephyr on her own. Jointly, they could then borrow another 2.5 million. So in actual fact, through a combination of applications, you could get to 7.5 million with Zephyr.
Mm-hmm.
So there's a big portfolio option there.
Yeah, and I think just back on the day one SPV point, Jordan, this is another area where I think it's bang in the heart of what is specialist buy to let. You know, we do quite a lot of analysis of what's going on, and you can certainly see how, you know, lenders that are perhaps, you know, more of a retail backed nature, bank building society, will often say there's a cap of, for example, 4 or 5 properties that can be in the background portfolio. Whereas, as Andy says, you know, it's very different with ourselves, and, you know, I think, to be fair, lenders in our particular specialist space. So yeah.
Fantastic. Thank you, guys. So here is actually thrown me off here because they've asked one live, which is the same as one that I've scribbled down from the registration, but I'll ask it now because it's described slightly better in the live box. So basically, we've got someone who wants to sell their SPV, and their client wants to buy the SPV company. There are 4 buy-to-lets in the company with mortgages on them with 4 different lenders. So Hero wants to know how the mortgages will be dealt with on the purchase of the SPV company shares by their client.
Wow, that's a great question. That's a great question.
I was going to caveat this one with, it sounds a bit sticky, so you might want to get back after the session. But I mean, if you want to answer it now, we can. If not, we can.
Yeah, no, I'm good to go with that. So why would someone look to buy a company rather than individual properties within it? Quite simple, stamp duty. So when you buy a company, the stamp duty excise on a company purchase is much lower than the stamp duty that you'd be paying on individual properties, dependent upon their value. The problem that you come across when you buy a company is the legal fees charged to buy the company are much higher than they are on a standard purchase of a property transaction. So you may be looking, for instance, at purchase legals of, say, I don't know, taking out stamp duty of maybe, I don't know, 1,500, 2,000 quid, whatever, okay? Whereas when you're looking at buying a company, you can be between 15 to 25,000 up to 30,000 pounds of legal fees to buy the company. Now that sounds like a lot of money, but if you look at 4 individual properties within an SPV and look at the stamp duty requirement on that, you could be looking in excess of 100 grand, of course. So actually then that legal bill in conjunction or alongside that, the stamp duty on the individual properties is a massive reduction in fees, which is why people look to do it. How would we and by the way, we allow a company purchase of this type, so we're one of the few lenders that will do this, so we're certainly interested in maybe taking this one offline to discuss the more critical detail on it. But from a high level overview, we will consider that, not a problem. You'd have to use one of our specialist lawyers to do it, which we can point you in that direction. What we'd be looking to do, of course, is to, provided you didn't burst any LTV limits or any max lending limits with us, i.e. the 5 million or 75%, we would look to raise, you can buy the company, but we'll actually secure an all monies charge against each individual property. So although you're buying the company, we will raise an all monies charge against each individual property. And then we will clear that universal charge in the background or individual charges potentially in the background as we go, and then we'll get them all to complete on the same day, and then we'll clear all those charges and we'll put our charge in place. But we can certainly consider that. So it's a great question because yeah, it's interesting. 5 years ago, you'd never get asked a question like this, or even probably 2 years ago. We probably have 4 or 5 of these this year. So you know, accountants are starting to look at ways to direct clients to think about how they're doing this, and this is something that's coming up more frequently.
Yeah, I think it's one of those situations which you couldn't dream up, and then it's all of a sudden lands on your desk, and you think, "Ooh,
correct."
I don't know what to do with that.
Yeah.
Cool. So moving on from the SPV area. So the second question that we asked on the registration form was, what difficulties are you facing from local authorities when supporting clients purchasing HMOs? And literally every single response that we got was either unable to get a license for a HMO or unable to increase the number of rooms licensed for an existing HMO. So I guess I'll open this one up to both of you. So your experience in the industry, is there anything that you can suggest on how to deal with this? And how to potentially get around it, or is it just a case of sticking to it and persevering?
I think it's a bit of the latter, to be fair, Jordan. You know, lenders are massively tied down to making sure that licensing requirements are in place at the point of application. Now, you know, not all properties require a license, of course. So if it's 4 or less bedrooms, then there's a strong possibility there's not a license required, which is great. Typically, mandatory licensing is on five or more bedroom type properties where mandatory licensing comes in place. So certainly from Zephyr's point of view, if it's a mandatory license, then we will want to see that license in place. Now, if it's a remortgage, it should already be there. So, you know, even if they've applied for a renewal, that's fine. And we do recognise that some of these renewals take, you know, 4, 5, 6, 7, 8 months to go through. As long as we can see that there's the previous license in place and that we can see that they've applied for renewal, then we're fine with that and we can go ahead with the transaction. So I think for a lot of people listening in today, that will probably navigate around the issue that they're finding, where they're saying, you know, we haven't got the license in yet. Can you do it? We can. If it's a purchase situation, if it's an existing HMO, again, we would expect the outgoing vendor to have had a license on the property if it's a requirement. So we would look to see that that vendor's existing license, okay, so that we know that the property is licensable from the local authority's perspective. And we'd expect to see that the applicant had applied to the local authority for their new license. And as long as they get the acknowledgement letter saying that the authority have received that application, again, we're good to go, because we know it's licensable and we know that it's in the authority's work queue to get around. So again, for probably 95% of the inquiries that are here today, that would probably circumnavigate that issue. Where we have a problem specifically, and it's the very small catchment in this sector, is where it's a conversion into an SPV or a conversion into an HMO or a brand new HMO, because then we're in a difficult position, because if we lend and that license isn't granted, we've got an HMO that's in breach effectively. So we can't secure a lend until that license has been granted. So the advice that we then give is to say, look, you know, you're going to have to wait until that license has been granted. The difficulty there, of course, is that if they're buying it, they need the license and they need the funding. So, you know, they may end up going to a very much more specialist lender that's priced much more highly, or maybe a bridging type arrangement where they can get that purchase underway, get the license application underway. But of course, they're at risk there. If that license doesn't get granted, then they're not going to be able to exit the bridge. So you've got a question about, you know, is this necessarily the right thing to be doing? I can't answer that on this. Of course, that's down for the advisor and the client to get into. But that's the reality of the potential issue that they may face moving down. So we wanted to bring this question in because we get asked this a lot. And I think, you know, there is no simple answer. You know, certainly from my point of view, you know, I've spoken to advisors and look, you know, have you actually chased up the local authority? And there can be merit in doing that, because sometimes he who shouts the loudest gets the best reward, unfortunately, in this world. And sometimes we're just talking to the local authority and pushing it, you can get your transaction moving a little bit. Not always the case. Some local authorities are, no, you're in a queue, that's it. But, you know, you've just got to do what you can to try and get it over the line. But that's the potential pitfall.
Yeah, and just off that kind of further understanding around it, because I think the fact that we get asked it a lot just shows that there isn't an easy solution to it. It does come down to your funding, you know, in the sense of, you know, when we fund the mortgages, you know, we're giving representations and warranties to the funder that the mortgages have got the right licenses and, you know, approvals in place. And with that gap, it just does create a problem for us. I mean, as Andy says, you know, bridge and stuff may be a route forward, but clearly not for us to really, you know, advise on that particular point, I guess.
Thank you, guys. So the third question that we asked just before we moved on onto the live ones, because there's a few more sitting in the box, was what challenges have you faced from lenders when trying to place larger portfolios? So the first one that I've got scribbled down here is from Hero, but obviously we've just answered that one. We've got another one from Nikesh saying the background portfolio stress test when it's done per property can be a bit of an issue. So is there any roundup you can provide on that?
Well, yeah, I mean, it comes back to what I was saying earlier, Jordan. I think for us, because we look at the portfolio as a whole rather than individual properties within it, we're looking at the total cash flow against the total output. So provided that rental income from the whole portfolio is equal or just greater to the whole mortgage payment for that portfolio. That's it.
Yep, that's fine. Sally again has mentioned too many in the portfolio, which I think we covered that off earlier.
Yeah.
And then we've got a couple in from Amjad and David, which, I mean, this question isn't specifically about Zephyr, so this answer might not be specifically about Zephyr. But from Amjad, we've got lenders asking information which doesn't seem to relate to the property. And the example that is provided there is a fire risk assessment.
Okay.
So, yeah,
tricky to answer without the.
Yeah, which again, I think it's slightly too vague on that one, but potentially, if we could pick that one up afterwards.
I mean, maybe a way just to answer that is that, you know, the way that certainly we operate our businesses is that, you know, we've got very much a person looking at the case. It's not an auto approach to underwriting. And, you know, often when we ask questions and you do look into it, if they, you know, maybe slightly, you know, sort of non-standard questions, there's often a good reason for it. So I guess it's just hard to comment without knowing the specifics of that particular case.
Absolutely. No, that's fine. And then again, like I said, this isn't specifically about Zephyr, but Davis said that there's a clunky process with multiple applications, which I think, going back to what you said earlier, is not specifically the case with you, depending on how it's all set up.
Well, I will. Sorry, Paul. I was going to say I will cover that, because with multiple applications, what we will do is that we will assign the same underwriter. Or we'll certainly try to assign the same underwriter. So if a broker's put a case in and we've got another case coming in for the same client, or maybe that client's doing an application in an SPV, so they've got one in individual names and one in an SPV, we'll get the same underwriter working on both cases, because the underwriter can cross-reference documents where they can, and there's a lot, of course, that they can cross-reference. There are certain documents they can't, of course, like a declaration and a direct debit mandate, etc., which we'd expect to see individual items on each case. But where we can cross-reference, we will, and the underwriter will look at both cases in the whole and report back. So we had a really good case study that we often present when doing other presentations about a deal that we did earlier in the year, which was a portfolio application for 20 clients. And I spent a lot of time, so not 20 clients, 2 clients, but I had 20 properties. I spent a lot of time working with the broker to walk through the background requirements on paperwork and so on and so forth. We got the case into the underwriter. We then supplied all the documents. The broker was brilliant, actually, got all the documents through. We got the whole thing underwritten in 3 days. So I think there's a determination from our point of view to be able to offer that kind of service. And it doesn't always go that way. And I'm sure there's people on the call that will go, well, I never had that when I put a case in. But, you know, the reality is, if you really stick to what we're looking for on the submission process point of view, and there's a document on our website called Submission Guide, if you get that right day one, we can underwrite really, really quickly for you. And the beauty of a portfolio case like that is we're looking at the whole thing together, so we can get it done really, really quickly. So hopefully that will get around that clunkiness. But, you know, it is part of what we do to some extent, but it's trying to make the machine work as smoothly as possible, I guess.
Yeah, I think there's a real variability, isn't there, to the circumstances that we get presented with. And I'd just say, you know, Andy is one of a team of 9, so having that early conversation about the detail in particularly a portfolio case really can pay benefits. And that particular case that I think Andy's referring to, if I recall, you know, that was also in the sort of realms of wealth planning and such like. So it was a really good case study that I think is on the website somewhere, actually.
Yeah. There were quite a few aspects to the case. You know, there was, you know, we did cross subsidization in the background. You know, it was a like-for-like remortgage, but building in professional fees. There was loads going on with it. It was a really interesting case study. So
yeah, that's a good point on the background stress, isn't it? How, you know, not all the properties actually met the stress calculation, but as a whole, it did. You know, so having, you know, one underwriter looking at it as a whole, as a business proposition, worked, and that all completed pre-stamp duty deadline as well.
Fantastic. Which I think that actually leads quite nicely on to the first one in from Mandy, who's just gone straight to the point, which I know we've skirted around, but she said, can you confirm your stress calculation on background portfolio?
So stress background portfolio is 100%. That's it.
Is it?
100% at the current pay rate. So very, very simple.
Fantastic. And then Mandy's just asked a second one, which is, do you accept gifted deposit when the purchase is a limited company?
Yes, we do. Yeah, yes, we do. And that's another good question. So we will allow gifted deposit from, it might be controversial, this one, because most lenders will only accept gifted deposits from immediate family. We will do immediate family and non-related people. Now, if it's a non-related gift, of course, we want to know the background. We want to make sure there's no, the client's not under any kind of duress, or the person giving the gift is any kind of duress. We need to understand the mechanics of what's going on, of course, as part of due diligence or diligent underwrite, but we will allow it. Of course, what we will also ask for is that the person giving the gift signs a gift letter waiving their rights to the gift and the property, of course. But with that non-related person, we're making sure there's no pending insolvency issues in the background and that kind of stuff. So we're going to do some digging, but we can allow it. It's absolutely fine. And that's gift of cash or gift of equity.
Fantastic. Thank you very much. And finally, I think we've got one in from, just let me check the chat box, from Linda. So this one is, which I know we touched on this at the beginning, so I'm not sure if Linda maybe joined slightly later, but do you accept intercompany loan as a deposit for the new SPV?
Yeah, absolutely, Linda. So you may have missed at the beginning, but provided the shareholding and directorships are identical between the company giving the gift and the company, the SPV, receiving, and that the gifting company convene a board meeting and create a board minute, basically allowing the gift, and also there's no repayment plan in place while our loan is live. That's absolutely fine. We can accept that. But if you want to get into the detail, Jordan can share, well, all of our contact details are on the website, actually. So phone myself or your local RSM or TBDM, and we'll be able to talk you through the actual minutiae of your case. That's not a problem.
Fantastic. And like I say, we will be sending the data over to Zephyr as well, so they can contact you directly. So I think we're just about running out of time, actually. So if we could get the third poll on screen, please, Paul. Thank you very much. Then, yeah, I'll just give you a couple of seconds to answer that. Apologies, like I said earlier, if we didn't manage to get to your question, but we will send it over to Zephyr so they can contact you directly. Just to confirm again that the confirmation of attendance that you can use for CPD will be sent out this week from Knowledge Bank. And if you want to share this webinar or rewatch it again, the recording will be available on Zephyr's website over the next coming days. So the next webinar that we've got is a criteria clinic, which is actually on heavy refurbishment bridging, which, if you were wondering earlier when Andy touched on that, if it'll be relevant, might be interesting for you to join. So that's on the 13th of September. So make sure you don't miss out on that one. You can book onto all of our events on the Knowledge Bank website, which is knowledgebank.uk/events. Yeah, so thank you guys for attending. Thanks for joining us, Paul and Andy.
Thank you. That was good.
I hope to see you all again soon.
Enjoyed it, yeah.
Cheers, guys.
All right.
Thanks, everyone.
Fantastic.
Cheers.
All right, guys. Have a good week. I'll speak to you
And
soon.
cheers. Thanks all.
Cheers.
Bye.
Bye-bye.